Welcome to Get Started Investing. In this podcast, we cover all the basics you need to start your investing journey. We unpack all the jargon, the confusing bits, hear your investing stories with the goal of making investing less intimidating. And along the way, we're going to try and have some fun. My name is Bryce, and as always, I'm joined by my equity mate, Ren. How's it going?
I'm very good, Bryce. Look, as I said that, for context, we're on YouTube now, so people can now watch what we do in the studio.
Yes.
I've got some feedback that I play with my mic a lot.
We don't touch it.
Just as I went to say I'm good, I realized I grabbed my mic again. So everyone watching it on YouTube, get ready. I'll be touching the mic a lot in this episode.
So in this episode, we want to cover all there is to know about compounding, the eighth wonder of the world, according to, well, technically Einstein, but there's debate as to whether he said it. But we're going to be going through, what is compounding? It's a very important term to understand at the beginning of your investing journey as early as possible, because it is quite a powerful concept. So we'll be going through that and then closing out the episode with a listener mailbag from one of the members of our community, and that is Bridget, who has a couple of questions around sustainable investing and one of the funds that we had spoken about earlier on in our investing journey, Ren, many, many years ago, PM Capital. Before we do jump into the compounding part, though, we do want to again thank all of you out there who have gone to our equitymates.com/support page and either supported us through a one-time donation or through a recurring monthly. It is obviously something that we're very grateful for, so thank you very much. If you would like to support Equity Mates and everything that we do, and you find value from this content, then head to equitymates.com/support. You can give us 10 cents, $100, or 100,000. We don't mind.
100,000 would be very nice.
So, a massive thank you to all of you out there. Also, a reminder, Ren, that we have launched Meet, Pay, Love.
Yes.
Which is our latest podcast at Equity Mates Media. It is all about the money side of relationships, hosted by two amazing sisters, Carmel and Zoe, down in Melbourne. They're tackling the issues that everyone faces and should be talking about with their partners when it comes to money. Everything from going on the first date through to de facto relationships, and who gets what if there is a divorce.
Yeah, now I'm not in a relationship, but I still got something.
You can slide into Ren's DM if you want.
That wasn't the point of that. But I still got something out of it. I still found it interesting. But you, as someone who's been in a relationship for 9 years?
Quite a while.
Probably I hope you got something out of it. Did you? Have you had any serious money conversations with Harriet since?
Well, I mean, we've been having conversations before the podcast, thank goodness. Okay. But I have taken a lot out of the podcast that the girls are doing. So, I think that the message is that regardless of if you are single or in a 25-year relationship, there is something to get out of this podcast. So go and check it out. Meet, Pay, Love. It'll be live in your podcast players now. Yeah,
there's a lot of conversations about money that don't happen in relationships, and hopefully this podcast can break down some of those barriers.
Absolutely. And just a final shout out to our community investor from last week's episode, Candice. It was great having you on. A reminder that if you would like to come on and share your investing stories just like Candice did, head to equitymates.com/contact and leave us a voice message or leave us an email and we'll get in touch to bring you on the show.
Geez, this housekeeping section is getting very long.
It is.
We'll be soon be releasing a special bonus episode, housekeeping.
That's not bad. Right, Ren, so compounding.
Yes.
Since the creation of the first company, nothing has created more wealth than the stock market.
Well, it's something that I like to say, and it's been challenged. Property potentially, but
you're fiddling with your mic.
With the mic again. But I think since the 1600, I'm very conscious of it now. Since the 1600s, the creation of the first joint stock company, it would either be stocks or property. It would either be number one or number two. But it is just an incredible wealth creating machine.
Yeah.
And it's it's pretty simple at the end of the day. It's not highly technical, trading and, all this stuff. It is simply just investing in these companies and waiting and letting them do all the work as they get more valuable. And every year getting a little bit bigger and a little bit bigger.
Yeah.
And compounding into something pretty incredible.
So we're going to call this episode "Don't Wait to Invest, Invest and Then Wait," because that is the power of compounding, as Ren just said. If you just let it build and build and build over time, as you'll understand as we go through a few examples, it becomes incredibly powerful. So Ren, Einstein apparently has said that compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And so hopefully by the end of this episode, you will understand it. We also reached out to some of our community to get their idea on compounding. And one of them has said that compounding to create a passive income is truly powerful. And it is something they did not quite realize at the start of their investing journey.
Yeah. And so I think the point of this episode is just to really understand what we're talking about when we're talking about compounding and how it can work for you and, what you need to do, but probably more importantly, what you don't need to do to really enjoy its effects. For some people who, have been investing for a while or been with us on the journey, they're probably sick of us talking about it. But you know what? It's that important. We're going to do it again.
Yeah, absolutely. So, I mean, Ren, you're at school and you're in your maths class, and you've probably
I actually dropped maths.
Oh, really? Yeah. And you're doing
and now I'm doing a finance podcast.
Gee, that is not good. That is not good. Anyway, people may have heard simple interest,
yes,
and compound interest. What are we referring to here when we're talking sort of our compound interest?
Well, hold on. Let's take a step back. So interest is the money that you earn on your money in the simplest sense. So you've got a bank account or you put your money in a term deposit or whatever, and the bank pays you some money for putting your money with them.
Yeah.
That's called interest, normally expressed as a percentage. So let's say you put $100 in a savings account and you get 1% interest. The bank's paying you $1.
Yeah.
Yeah. So that's interest. There's two types of interest. Simple interest is on that $100, if you're getting 1%, every year you just get 1% of.
So
of
every year
$100.
I will just receive $1.
$1, yeah.
$1 year one, $1 year two, $1 year three, etc.
Yeah. Compound interest is where you get interest on the original amount you put in, and then all previous interest you've earned.
So I've put in $100 and that's 1%. The next year I will get $1 for that. But then I have a total of $101, and then the next year I will get 1% of $101.
Yes.
And then the next year I will get 10% of
maths?
the $101.01.
$102.01.
Whatever it is. Yeah. And
So
it continues to build that way.
That's it. And so and to put it in the context of the stock market, that's really what we're talking about when we're talking about your money compounding in the stock market. If the stock market grows on average at 7% a year, the first year on the $100 you invested, you get 7%, so you get $7. But then you have $107, and so you make 7% on that, and so you make even more, and then you've got more to begin with, and then you make even more, and it just snowballs into something really quite meaningful.
Do you have to be paid interest or dividends for compounding to take effect?
No. So what we're mainly talking about here is the growth in the share price.
Yes.
Yeah.
So, yeah, it is the growth in that price over time, year after year after year. It's not necessarily you actually receiving any interest or dividend payments.
No, but it helps.
It does help.
It
absolutely.
helps.
It accelerates the process.
As long as you reinvest the dividends.
Yes.
So if you get cash and you go spend it on, more hair gel or whatever else you're buying, unironed shirts,
I know, I saw that.
then you won't compound. But if you get that money as a dividend payment from your company, and rather than spending it, you put it back into the share market, that will help that compounding effect. So I've got some numbers for you.
Yes.
Even though I dropped maths in year 12, I can still
You've gone
use
back to the
Excel. So extending that $100 example and using big round numbers, let's say I had $100 to start investing and I earned 10% a year on that.
Yep. Or it grew 10% a year.
Well, yeah.
Yeah.
So with simple interest, so if every year I just got 10%, in year 1, I would get $10. And in year 2, 3, all the way to 20, I would still get $10. At the end of it, I would have my original $100 that I put in, and I'd have $10 a year for 20 years. Even I can do that maths, $200.
Yes.
So over 20 years, you've got your 100 you originally had and 200 you've made. So you got $300. Not bad. Not bad. You've tripled your money.
Yeah.
But if that was compound interest rather than simple interest. So year 1, you put the $100 in, you get 10%, so you get $10. Same as simple interest. But then you have $110 and you make 10% on that. So you get $11 the next year. And then you have $121 in year 3 because you add the 11 to the 110. Then you make 10% on that. You get $12.10. And you can start to see how you're just earning a little bit more every year. And it doesn't feel like much. But over the course of 20 years, in year 20, with simple interest, you'd be making $10 that year. With compound interest, you're making over $60 of a $100 original investment. And so after the 20 years, you would have earned $200 with simple interest or over $570 with compound interest. And so you can just start to see that over time, that gap really starts to widen and the numbers start to get quite meaningful.
Yeah. The benefit of time is the critical part here. It's, if you were to look at those numbers again and compare it over 3 years, okay, it's not a huge difference.
Yeah.
But if you start looking at 20 years, if you start looking at 30, 40, 50 years, and particularly if you're starting your investing journey, in your late teens or your early 20s, if you have the ability to think really long term and put that money away and just let it compound, then it really starts to become exponential later on in life when those, if you're compounding 300,000 at 10% year after year, 400,000 at 10% year after year, those numbers really start to add up quickly.
So that's I think enough theory about compounding.
Yes.
I guess when we apply it to the share market, what we can see is that that theory holds. That theory has held historically.
Jeez,
so
I'd hope so. Otherwise, we'd have to finish the episode here.
And I think really the point when we're talking about the share market is it's great if you want to pick the next Microsoft or the next Apple or the next Amazon, and become a millionaire by the time you're 30. Like, power to you. We would love it as well. Bryce is 30 in like a couple of months, so he doesn't have much time.
But I'm almost there.
But this idea of compounding your wealth, you don't need to be finding that needle in a haystack, that next superstar company with the Jeff Bezos leading it. You can just invest in the whole market. And so I've looked at Australia and America. So in Australia, I've looked at our All Ordinaries Index, which is like the 500 biggest companies. In America, the S&P 500, again, the 500 biggest companies. If you just invested in the index, so just bought an ETF that held all 500 and held it for 40 years. So 1980, you've started out your working career, you're a young go-getter, 20-year-old, in the 80s, Reagan's president, Hawke and Keating are running around in Australia. You save up 1,000. Have I set the same for you?
Yeah. What transport would they be going to work on?
Bicycle.
Bicycle.
Yeah, you can't afford a car yet.
Yeah, true. $1,000 as well is a fair bit of cash back in the day.
True.
Yeah.
All right, so you saved $1,000 and you invest it in Australia at the start of 1980. By 1989, it's just a scratch over $5,000, $5,088. Not bad. By 1999, it's $14,500. By 2009, it's $33,500. By 2019, it's a bit over $70,000, $71,800, and just that's the Australian All Ordinaries total return.
Yeah.
In that time, think about all the stuff that happened. We had the tech bubble burst. We had the global financial crisis.
9/11.
We had 9/11. We
Yeah.
had, Australia, the recession that we had to have when Keating floated
Did
the
you say
dollar
the
and all of that.
GFC?
I said the GFC. We
Yeah.
had the 1997 Asian financial crisis. Like, we had the Iraq War. We had, so we had so much. We had the, Bali bombings, all that stuff. I don't know what effect that had on the stock market, but like all that wall of worry that, you think about the stock market and you think about how risky it is. But this young go-getter in the 1980s who just put $1,000 in the stock market and left it for 40 years.
Has walked away with $71,800
And
from doing nothing.
Not picking a stock,
Yeah.
not watching their investments every day, not waiting for the right time to invest, not buying and selling or trading, putting it in and waiting.
And that's without even adding anything as well.
Yeah.
Imagine if you then took it to the next stage and said, all right, well, I'm going to put in 1,000 every year.
That would be crazy.
Then he's going to be walking away with hundreds of thousands if he lets the compounding do its thing. What about in America? Are we looking any different? I mean, here we go. Similar, 1,000 to 86,900 over a similar period of time. And again, Ren, same thing. Many world events, and I think that's a really good point. And it's actually one that's really hard to keep in context when shit does hit the fan.
Yeah, and this America one is a really important example because, as you said, shit hits the fan. And so just to run it through, because there'll be something that jumps out at you, I hope. You start with 1,000 in 1980. By 1989, you have about the same, just a scratch over 5,000. By 1999, you've got 26,500. And for those that can remember all this string of numbers that I'm just saying, the equivalent in Australia, you had 14,000 at that time. So the US,
serious growth.
The US killed it in
Tech
the
boom.
the 90s tech boom. At 1999, you had 26 grand. 2009, you had 24 grand.
What the?
Yeah. And then, so that, like, obviously we went from 1999, tech was booming.
Yeah.
We had the tech
GFC.
bubble collapse, and then we had the GFC. And so in that 10-year period, you lost money. Shocking 10 years. Like, you'd be
Not great.
You'd be spewing if you were checking your account every day.
Which you shouldn't.
But between 2009 and 2019, you just held the S&P 500 total return. It goes from 24 grand to 87 grand.
In 10 years, you've gone from 24,000 to 86,000. Yeah. Pretty phenomenal. So I think the key lesson from this really is, I hope you can see the power of compounding in both examples we've turned. $1,000 into 70,000 or 86,000, near 87,000, from doing nothing but holding the main index in both Australia and the US. That is all you've had to do, and just let compounding do its thing over a 40-year period. This is the key point. You start to exponentially grow the longer you hold these things. And secondly, as Ren has pointed out, there are many instances of market corrections and worry and opportunities for you to panic and sell. But if you just stick with it, the further you zoom out on a stock chart, the, I guess, less worried you should become, because you can see that over a long period of time, generally speaking, the stock markets do recover, and you just need to hold your nerve when it starts to wobble a little, and just remind yourself that this is a long-term game.
Yeah. And now this episode probably is completely flying against our interest, because people could listen to this episode, invest in some index funds, and then just sack it and listen to, I don't know, Shameless or Hello Sport or some other podcast instead. But I think that's the point, and like that's one of the key things that we've learned over our journey. Like we love talking about investing. We're obviously doing it full time now, but you don't have to feel like you have to be constantly plugged in. And I think that was something I definitely felt when I got started. I felt like if I wasn't always paying attention, I wasn't keeping up, and then I shouldn't do it because I wasn't keeping up. But that's not the case. Like, don't wait to invest. Invest to wait, as the name of this episode is. Just invest and wait, and don't stress.
Don't stress. It's a stress-free game over here. So before we jump into our mailbag from Bridget Wren, I guess the question is, how can we easily achieve compounding? And I'm talking about, sort of from a product point of view or an investment strategy point of view. And as we've mentioned a number of times here, we believe one of the easiest ways is to just hold an index. There's many ETFs available. We've done a series on Get Started Investing all about ETFs, so head over and check that out. It was ETFs for Beginners, where we go through a number of the ETFs that track indexes both here in Australia and overseas. But there's probably no easier way to do compounding than through sort of like an index.
So there's two elements to compounding. It's earning a consistent rate of return and then over a long period of time. And so the first one is buy into, you can compound an index, you could do a thematic ETF, you could do an individual stock, but just keep in mind that the riskier you go, or the more specific you go, the less likely you're going to get a consistent rate of return, because companies are more uncertain and thematics are more uncertain. But you need to just find a few things to invest in and then hold it for a long period of time. The worst thing you can do is try and trade in and out of positions, because that's the quickest way to start missing some of the big moves up. So I think, for me, it's a dollar cost averaging play, and that's how we talk about a core and satellite portfolio approach, which we'll probably do an episode on soon. But in my core portfolio, it's very much just putting a little bit of money in every time into some pretty vanilla index funds and ETFs, and just hoping that I can be like that young 20-year-old in 1980s who holds for 40 years and ends up with something quite meaningful.
So, Ren, I hope everyone has been able to get something out of that episode. I think the main point is, don't stress. Let compounding do its thing.
Don't stress. That is the main message.
Yeah, it is the eighth wonder of the world, according to Einstein.
If you Google the quote, it'll be Einstein, but apparently he never said it, so I don't know.
Whatever. Yeah. It's not like we can ask him.
It's not like he's alive to tell us
Exactly. So we're going to move to a listener mailbag now, and this one has come in from Bridget. She's left us a voice message over at equitymates.com/contact, and we're going to have a listen to that now and then briefly answer her questions.
Hi guys, love your show. I have just sort of started looking into investing recently, and it's definitely been a big help in understanding how to get started. I have two questions. My main question is, I'm wondering how to invest sustainably or ethically, and I noticed that there are some ETFs where this is sort of explicitly in the title, ethical investments, etc. I just guess I'm wondering, do you guys look into investing sustainably, and in those sort of larger ETFs or some of Vanguard's big ones, is there a way to tell if they are investing sustainably or not? And how do you guys tackle that? Because I don't really want to accidentally invest in coal or something, for example.
So, Ren, the question from Bridget obviously is around sustainability. Is it something that we do, and how do you know if it's legit on the tin?
Well, you certainly don't, because
here we go.
You do a lot of gambling and cigarette stocks.
Not true.
Cigarette stocks have been good dividend payers for you.
Not true. Anyway, I don't actively invest in any sustainability funds.
Because you're just a terrible person who loves coal.
So that's the short answer for me. I don't actively have any specific ETFs that are focused on sustainability. Sue me. I might, but yeah.
I will sue you.
Do you?
Yeah, I do. I own what's the EFI, the Beta Shares Global one.
Yep.
I think the answer to the question is there are a number of products that are ethical on the label, and you've just got to have a look because at what they're holding, because everyone's ethical standards are different.
Yeah.
These days, you're not going to find coal in any sustainable fund. Although I did see a press release a couple of days ago that announced, I'm not going to name the company, but to celebrate the 3rd year of this Sustainable Leaders Fund, we're announcing that we're removing all coal stocks. And it's like, what have you been doing for the last 3 years?
Yeah.
But I think so. Like, I'm looking at the BetaShares FE holdings now that you can go to their website. Any product issuer, like an ETF issuer, on their website will say what they're holding. Second biggest company, Tesla. Tesla is undeniably doing a lot of stuff in the renewable energy space, electric cars, great for the world, great for climate change. But for some people, they will look at the labor rights or the corporate governance of Elon Musk and say, I actually don't want to invest in Tesla for that reason. And there's a bunch of companies where there's sort of like an on one hand, on the other hand thing, you know, like companies like Toyota and Ford and stuff are in a lot of these things, and that they're doing a lot with electric cars. But a few years ago, they were probably some of these legacy car makers were the biggest things standing in the way of that transition. And so people, you know, Apple, like on some things, you know, they're doing a bunch with renewable energies. They seem to do a lot, but their working conditions in factories in China have always been a question. And so ethics are really hard because they're so personal and everyone's got different standards and stuff like that. So go to the website, have a look. If you're investing in a non-ethical product and you want to see what's in there so you don't accidentally invest in a coal company or an oil company or whatever, same thing. On the website, it will have all the holdings if it's an ETF, or if it's an individual company and you're not sure what they do, well, probably know what they do before you invest in them. But go to their website, read the annual report, all that information will be there.
Yeah. It's still a very, very much a grey area. We are pretty confident over the next sort of 5 to 10 years, there's going to be more and more products that come to market that play in this space and allow for much more choice. But for now, as Ren said, have a look under the hood of these ETFs and really going to have to make your own decisions.
Yeah. And, you know, there's some big, well-known ones, you know, like the Future Supers or the Australian Ethical Investments of the world. And then, there's a bunch of ETFs with sustainability or ethical on the label. So that's probably where you want to start.
So that brings us to the end of Equity Mate's Get Started Investing. As we said at the start, please do contact us if you would like to come on the show and share your journey, or if you'd like to ask us a question. We are here to help you on your investing journey, break down barriers. Remember, though, that we also do have our Equity Mates Investing podcast that you can move across to once you're starting to feel a bit more confident, where we have plenty of conversations with experts in the industry, as well as have a bit more of a detailed chat about the stocks that we're excited about, our core and satellite portfolio as well, plus breaking down some more, I guess, confusing elements of the finance world. So head across there. We've also got Meet, Pay, Love and also Comedian v Economist, 2 podcasts in Equity Mates Media that are well worth checking out. Also, finally, to close it out, we've got a number of emails. I would suggest getting started with the Get Started Investing email, which you can do via our website at equitymates.com/email. But otherwise, Ren, always fun to chat.
We're going to have to change the name of this show to Get Started, Stop Housekeeping.
No, it's important. But good to chat. We'll pick it up next week.
Sounds good.